Good morning and welcome to the Saxo Bank Morning Call. It is Monday, March 25th. And boy, did we have an interesting end to last week. A couple of things to unpack here. I think the most interesting thing being that last week was an FOMC week and we saw an extremely dovish turn from the Fed, about as dovish as one could imagine. So what we had was an interesting setup coming into Friday. We had a Thursday that was very ebullient, at least in terms of risk appetite in U.S. markets. There was also quad witching afoot here, so there was flows linked to that, the expiry of options and futures. But the interesting being we had that late Wednesday FOMC meeting, extremely dovish turn. People take it as a big fillip to stock prices, a massive new rally, and there's also key technical levels in play. I have a chart here of the S&P 500, that 2800 plus area that was in play. In the big rally there Thursday, and then Friday comes in and we have the complete turnaround and markets absolutely smashed lower. Peter, you've been completely away from the markets for a couple of weeks here, but any spin on what I just said there? I mean, it was a really ugly session. Actually, I think it looks like actually the worst since those December lows.
Yeah, exactly, and I think it's an echo of the PMI figures that we got out of Europe. Asia continues to be weak, and I think the big question here is, yes, the central bank might be becoming more dovish, but is it enough to really, offset that weakness which has been going on now for months? And maybe the market is realizing that earnings could also be lower. We're heading into the Q1 earnings season in 3 weeks' time, and I'm pretty sure the Q1 earnings will show much more restraint and also cautiousness from companies, and earnings being extremely weak in Europe and Asia.
Yeah, I think maybe the markets as well just spooked a little bit by the entire idea that here we have the Fed being about as supportive as it possibly can.
Yeah.
And yet markets are maybe not responding any further because they've already responded so profoundly from those December lows.
Yeah, I'll just say there was one big headline last Friday as well, yield curve.
Yes, I've got a slide on that. We'll talk about that for sure. Yes, definitely. And as well, if we look at where this played out in the rest of the markets, obviously Treasury is extremely bid, and we'll talk about the yield curve in a second. The U.S. 10-year, especially at the longer end of the curve. But as well, if we look at the currency market here, dollar-yen chart here, a big acceleration and yen upside. We saw dollar-yen coming down on the FOMC reaction. Tried to bounce a little bit on Thursday with all the excitement about risk appetite, but then the Friday session, seeing it lower. You see the Ichimoku cloud level coming into play there, and the big sort of psychological level around 110. I think sets up potential further declines if the mood doesn't quickly improve here. And of course, that's leading to weakness in Asian markets. And actually, I want to skip ahead to our yield curve slide. I'll get back to some more thoughts on Asia, Peter, in a second. But here, as Ola mentioned, the yield curve, a lot in focus. What am I showing here? This is the euro-dollar curve, so what the market is starting to price from the Fed. So this is the September to 2019 versus September 2020 spread. It's basically showing you that between that September meeting and next September, the market pricing 33 basis points of easing. So more than a rate hike, and actually there's a little bit of a rate cut priced in even from now until December. But you wanted to try to find something positive in the market, and one of those things, there is some talk that China's trying to stimulate a little bit on its side, and you're seeing a little bit of effect in some Asian markets, Peter.
Yeah, exactly. In my equity monthly updates, I've focused on these OECD leading indicators, and the current regime we're in is still that we're growing below trend, and we're still accelerating to the downside, and that typically is negative for equities. The reason why we're still maintaining a defensive stance here. But I'm highlighting on this chart here that which you can see on South Korea, because I mentioned that in last month's equity update, where there were some signs that South Korea was slowing down in these leading indicators, i.e. turning around, and the January numbers looks like a small uptick there. We have had previously false turning points, but this actually looks like a pretty sharp turnaround, and this, I presume, is directly linked to China. As you said, China is doing a lot on the stimulus side, and if we see any impact of that stimulus, we will see it first in South Korea, simply because they are so front-loaded on the whole supply chain in the global economy.
Right.
So this might be a green shoot here.
Okay. Let's hope so. Ola, one thing we talked about earlier, this, we got a dovish Fed, risk off. Gold, yes, it's rallying, but it's not very impressive.
No, we really almost got everything we wanted. If you are a gold bull over the last few days, the stock market starts showing some weakness, the collapse in the bond yields, and also the yen strength that John just mentioned. I just highlighted this on the chart here. We can see on the right there, both the 10-year real yields have collapsed now over the past couple of months here, and the dollar yen moving lower as well. These should both really be bullish for gold. It is, but you can see gold is still grinding higher, but I'm calling it at a grind at this stage, but because we're not really seeing the spark that you would expect when everything else is turning gold friendly. So I'm just a little bit worried here. I'm just highlighting a couple of levels. 1305 to the downside is really that uptrend. If we start to take that out, then there could be some concerns. Likewise, if we start to make it above, if you can close above 1325, then there will probably be some more buying coming in.
Any general comment on positioning? We've had this latest weekly refresh on the futures positioning.
Yeah, the cut report will be out in an hour's time or so, but we did see some chasing the market in recent weeks. The market is really, traders been very confused about the gold action. So they're buying at the highs, they're selling at the lows, and last week there was some renewed buying coming in. So it is finding some support, but position-wise, nowhere near what we've seen in the past.
Right. Okay. Now this is Brexit week. Potentially a lot of clarity coming very quickly from Brexit, or maybe not at all, and further extension of uncertainty. So let's look at the chart here of Euro Sterling. You're seeing the sterling actually coming reasonably back bid, so it doesn't look like the market is particularly unsettled. We got that extension. We're waiting for this third vote on May's deal. But if you look at the options market, which I've shown here, I've shown a couple things. The cable 1 month volatility is the main black line. You can see 1 month volatility is spiking back higher. We're still concerned that there is some sort of outlying risk of a no deal, and that's especially expressed in the 10 delta risk reversals. That's the blue line there. You're seeing the premium that people are paying for extreme downside protection, 10 delta puts, which are trading at a 5 handle implied volatility premium to the calls. So there's you have a market here that's assuming or hoping, with quite high probability, this is not going to be a no deal, but there is this outlying risk that is indeed what we see. So we're going to see a vote. We're supposedly sometime this week. Of course, if that vote does succeed, May's third vote, then we have sudden clarity. We could see a quite profound sterling rally. Otherwise, there are a couple of drawn out uncertainty over delay, or this no deal risk. I
think it's quite interesting as well. I just done the report on sterling positioning, and that was actually the biggest mover last week. There was a cut in the net short to the lowest in 9 months. I think it was a 62% reduction. So obviously that doesn't really, that it could indicate that that something is something not quite right here. But also the lack of breakouts has probably left a lot of shorts confused, and instead they're going through the options instead.
It's very risky trading the spot because we know it can move a lot, and I think maybe, again, I think the confusion is more indicative of the confusion than that people are taking a directional view on that. So be very warned that we have very little visibility, and the visibility has gotten worse after this latest delay in the Brexit process, this 2-week period, all of this. There are so many options. You can do logic trees on which way this can, which way this can go, but stay on your toes and be careful for any sterling exposures. Before we get to the calendar, Ola, we have you had some thoughts on the grain markets, which have not been cooperating with the very, very bearish fundamentals and very short positioning.
No, exactly. We have I just took corn as an example this morning. We did see last week that the short there continued to extend, and if you look at the chart, you can see the cut report on the left there. The yellow line is the net. We hit a record short last week, and at the same time we're actually starting to see corn prices move higher. I mentioned at the top there we got the record short. There's now a planting delay potentially impacting the amount of corn being planted because we have this extreme flooding across the US Midwest. But also there was a big buying of from China last week, potentially just a goodwill purchase as these trade negotiations carries on. But the grain sector, I think, is starting to, or the agriculture space in general, coming out of a big short. So there are some opportunities there emerging on the upside.
Good stuff. So let's go to our calendar for today and for the rest of the week. I think it's a very interesting one, potentially this German IFO survey. We had that horrific manufacturing print on Friday, if I recall, 44.7 for the flash March PMI out of Germany, a big further deceleration to the negative side. So the IFO could carry a bit more weight, also because market temperature has risen so much. A couple of Fed speakers, one of them a voter speaking out in Asia later today, and then an RBA official also out speaking. Rest of the week, it's about RBNZ. Kiwi priced, I would say, argue for perfection in this environment, so a potential for a pivot there. And then we have the U.S. inflation data up on Friday as the sort of highlight for the U.S. Data this week, but with the Fed sitting on his hands, I think it's going to be a lot about risk on, risk off. Look at the longer term risk. It is Brexit week. It's hard to place all the Brexit stuff on the calendar. Could be up tomorrow, this vote. We'll keep you posted on that. And as well, I think there's a crescendo of wonder what is going to happen with the U.S. China trade deal. We've seen some negative headlines ahead of the weekend that maybe the U.S. is seen as asking too much from the Chinese side. And if there's no agreement, good deal, bad deal, weak deal. I think the weak deal is maybe the risk here. And as well, Trump, I think, has much more bandwidth for focusing on this issue now that this Mueller report is not going to come out. And it looks like Trump will not be facing some sort of indictment or further pressure from that side of things from the Mueller investigation. And that I think could add further energy into this focus on the U.S.-Chinese trade negotiations. I think it's going to be a busy week ahead, so stay careful out there, and we'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.